Hello and welcome to the Treasury for a Tax TV special. Speaking to David Gork, the Exchequer Secretary to the Treasury this evening, on the day he delivered the announcements, the Finance Bill announcements to the House. First of all, Mr Gork, thank you very much for joining us this evening after what I'm sure has been a very busy day for you. But the Finance Bill, obviously now we know parts of it. What, in your eyes, what are the most important things for us to pick out from it?
Well, I think there are a number of things in there. I think the first point to make is that I'm pleased that we're continuing with the process of publishing the majority of a finance bill some months in advance, ensuring that there's greater stability and certainty within the tax system. So I'm pleased we're continuing with that process, and I think that we've set a precedent now, and I hope this government and future governments will continue to do that. As for the contents of it, there are a number of things in there. A lot of it has previously been consulted upon, so there shouldn't be too many surprises in there. There's some additional anti-avoidance measures, but this is an opportunity to legislate on various things. For bigger businesses, there's the reforms of controlled foreign companies and the patent box. We've put in place some legislation for enterprise investment schemes and VCTs, reforms of that. We have legislating on domicile, reforms of domicile, although we've decided to hold back for a year on reforms of the statutory residence test. I'm sure we'll come back to that particular issue. But there's a whole scope of reforms, the treatment of life assurance, that's changing. There's a lot in there, but I'm pleased that people have got the opportunity to examine the bulk of Finance Bill 2012 now in December, and have got some months where they can look at it, comment on technical points, and feed in so that we ensure that we've got the best possible legislation next year.
And obviously the intention of what you're doing is not to produce a mini budget, so we should be perhaps not too surprised that the headlines aren't going to jump from the page on this document. But at the same time, you've already mentioned a couple of things there. First of all is the EIS, but rather the small EIS, if you like, the EIS for smaller businesses. Perhaps you could talk us through what that's for and whether who you think will actually go on to use it.
Well, we've talked about some of the things that come on from the announcements we made last year, or I should say in the budget, about EIS. And those reforms in there. We also made an announcement at the time of the autumn statement last week about the seed enterprise investment schemes. That legislation we will be publishing in January. We want to make sure that we get that right, and that will be produced in a month or so's time. But nonetheless, what we're trying to do with all of this is to make it easier for small businesses that at the moment, bank lending is difficult, we all know that. And we want to do what we can to encourage business angels and other individuals who've got money to invest to do so. And the Seed Enterprise Investment Scheme is a very interesting policy that means that the relief is actually not just 30% but 50% on income, and anyone who's made capital gains which they realise in 2012, they can roll into a Seed Enterprise Investment Scheme and avoid having a CGT hit. It's part of an attempt to get people investing in 2012. 2012 will be a really important year for the UK. We've got the Olympics and so on, and we want to provide this opportunity for 1 year only for people to roll their capital gains into one of these seed enterprise investment schemes.
And obviously the idea behind the seed EIS is to make sure that people are investing in family companies and people can become involved in that way. Do you think that the restriction, the traditional restriction on the EIS, the 30% maximum involvement, is that something that we should be nervous about? Obviously we might want to only have 2 or 3 investors who should be entitled to the same relief. It's just that because they're involved in the business anyway, that they might be put off by this new rule. I'm not convinced that the new rule will be as attractive as perhaps you're hoping it will be.
Well, it's an additional offer. The traditional EIS is being made more generous as you know. But in addition, and in quite specific circumstances, we are offering this additional opportunity, and we'll see how it works. But I think it is for many people, it will be a good opportunity to make an investment. And as I say, for small businesses that find getting money at the moment not easy, this is an encouragement for equity investment that we think will be a useful addition to what is already there within the tax system.
Okay, that was obviously something that Mr Osborne announced, and we're now going to look at in January. Something that he announced that we're now looking at sort of straight away is the capital allowance rules for some of the enterprise zones up and down the country. You're hoping this will encourage people to invest in these areas, I guess?
Yeah, absolutely. And not every enterprise zone will benefit from the capital allowances regime. Some instead will benefit from changes in the way that business rates will work. And essentially what we're trying to do is ensure that the right tax treatment applies to the right enterprise zone, because different types of enterprise zone have different requirements. Some are more focused on getting new business into the area. Others have got existing businesses, but we want to encourage further investment and so on. And we believe that the enterprise zone concept has got a big role to play. It is part of what we're trying to do to rebalance the economy so that we're not so dependent upon financial services, we're not so dependent upon London and the southeast of England. We think that this has an important role to play, as I say, to getting businesses investing and to ensure that we've got those clusters of high growth industries around the country and ensuring that we get the growth that obviously we need as an economy.
It leads me into talking about the NIC holiday, which was so loudly announced and yet, from picking up on various press releases, hasn't really worked out as you'd hoped it would.
I mean, it is right to say that take-up of the NICS holiday has been disappointing. It's been lower than we expected. We don't deny that. We've been trying to study why it's been lower than we expected, and some of it is to do with awareness. And so I'm always grateful for an opportunity when people raise it with me to remind people that for those areas outside London, the southeast of England, and the eastern region, for new businesses that have been formed, there is that opportunity to get a NICS holiday. We're actually seeing some pick-up in take-up over recent weeks, but it's still below what we expected, and part of it is to do with awareness. Those businesses, and I've spoken to a number of businesses around the country that have taken advantage of the NICS holiday, have said it's been very useful, very valuable for new businesses starting up. It helps on cash flow and gives businesses that bit of support at the beginning. But yes, we're not getting the take-up that we expected. We hope that take-up will pick up. But that's just one of a number of things that we're doing, and in particular, as I say, enterprise zones as well. And obviously in the autumn statement, we made a lot of announcements, not about tax, but about infrastructure investment that will also try to ensure that we see growth coming from the whole country and not overly dependent on one or two parts.
Okay. Staying with national insurance for a moment, there was a presentation which you gave at the number 11 a couple of weeks ago, and basically saying that whilst the Office of Tax Simplification suggestion on the merger of NIC and income tax was a good suggestion, perhaps it's not going to happen quite as quickly as we might have thought.
Well, what we're looking at doing is merging the operation of income tax and national insurance contributions. We haven't made any final decisions on that, but the Chancellor underlined our commitment to look at this particular point, because it does seem unnecessary that businesses, employers have to cope with two taxes, or a tax and a contribution, but very often doing the same thing, collecting amounts of money off people, when if we can simplify it, if we can find an easy way in which the operation can be merged, that would be of advantage to employers and also make the tax system more transparent. Now, this is an issue that's been looked at by governments down the ages. I mean, somebody at the presentation said, I used to work for the Revenue, and I looked at this in the 1970s. It is a tricky issue. It will have an impact on a number of people, a very large number of people would be affected by it. At the moment, we're doing quite a lot with the payroll system, if you like, the introduction of real-time information, reforms of pensions and so on. And we want to do this in a way that doesn't end up imposing a huge burden on businesses as they're coping with yet another reform of the tax system. So if we're going to do this, we want to make sure that we get it right, that we consult properly, that we bring people along with us. And we're continuing to explore this issue, and the Chancellor will say more in the March budget on that point.
If we could move on to, I would have lost an awful lot of money on the Finance Bill announcements today, because the one thing that we all knew was going to be in there was the introduction of a statutory residence test from April, and it's not there. Perhaps you could tell us why.
Well, we remain committed to a statutory residence test, and along the lines of what we consulted upon earlier this year. But essentially, whilst going through the consultation process, we have found that there are some very difficult issues that we need to address. This is a difficult area. There's a reason why it hasn't been dealt with before. And rather than try to put something out that isn't quite right, we would rather wait to get this right. But as I say, we remain committed to that. And the Chancellor in his budget in March will be responding to this further and providing further details to exactly how we're going to deal with this. And we expect that the draft legislation will be published for this time next year. So the project is still very much going to happen, but we would rather take an additional year to get it right, rather than try to rush it when there are some difficulties we still need to overcome.
And something that has come in, which we were expecting, was the introduction of a 12-year rule for the domicile, as well as the £30,000. Mm-hmm. We now have the 50,000 as well coming in for people here for 12 years. Why is there a need for a higher figure for people who've been here longer?
Well, we think it's right that non-doms pay their fair share, that they make a proper contribution. For those who have been longer, of course, it's optional. They don't have to pay the 50,000. They can waive their non-dom status and be taxed in the same way as everybody else. But we think that that is a fair compromise. As it is right that non-doms pay their fair share. But what we have said, and when we made this announcement back in March, is that that's the change, that's it. We're not going to be returning to this issue again in the course of this Parliament, so that there is sufficient certainty for people there. But it's a question of striking the right balance between ensuring that we attract people to the UK and keep people to the UK who pay a lot of taxes through all sorts of means, that the UK is an attractive place in which to do business. But also it's seen as being fair, and I think people who are still claiming non-dom status after 12 years or so, I think it's reasonable that we ask them to pay a bit more.
And you must be pleased with the announcements from the IRS in America that the 30 or the £50,000 they are going to view as being tax deductible.
Yes, and no, I think that sort of further underlines that we have got something that is sustainable, and that this isn't an area that we need to open up again in the immediate future. Okay.
One of the great risks you take when you have independent organisations, as opposed to historically where they weren't independent, is they might say things you didn't really like them saying. Mm-hmm. Obviously, as far as the Office of Budget Responsibility is concerned, we've seen some fairly dramatic cuts in what they had originally said. Yeah. The Office of Tax Simplification have said some things which, within the profession, I think a lot of people thought, I wonder if their government would have set them up if they'd have known that's the sort of comments they'd make. How do you think that relationship is going?
I think it's going very well, and you're absolutely right to say that they are an independent organisation. They are not there just to parrot what we have to say, or for us to get them to say convenient things for us. They will hold us to account. They will say things at times which are critical of the government, and so they should in a way, because it's important that they have a role to play in bringing the debate on, providing an institutional pressure towards simplification, I think, is a very useful thing for them to be doing. So I'm pleased with what the OTS has done, their review of reliefs, and within this finance bill, within the set of measures, we've got 36 reliefs that are being abolished as a consequence of what the OTS have recommended, and their continuing work in a range of areas, I think, is really important, and I'm pleased with the work that John Whiting and Michael Jack have done. and the hard work that has gone into producing some of their reports, and they continue to play an important role.
We asked our viewers to suggest topics that I should ask you about. Obviously, this was before the announcements, and so some of them aren't as relevant, but I will put the three of them to you. The 50% tax rate, what would you, obviously it's not mentioned today, but what would you say on that?
Well, what we've said on that is that HMRC will undertake a review of how much revenue has actually been brought in. They're not going to get all the information until the end of the self-assessment period and the returns in by the 31st of January. But they're going to make an assessment of actually how much money is being raised. And when we're in a position to see that, and of course there will be uncertainties in that analysis because there's a lot going on, but once we've seen that, we'll be in a better position to make an assessment of where it goes. But as we have said on a number of occasions, we think if it became a permanent part of the UK tax system, that could do lasting damage to our economy.
Okay. The second question to ask was Business Payment Support Service. To quote the viewer directly, the Business Payment Support Service is a joke. The problem that a lot of people are facing with it is that whilst it officially exists and you are allowed to ring them and say, please can I have time to pay, basically they're saying that very, very few people are receiving that. And obviously it wasn't something that was mentioned today, but I did say that as I was meeting you, I would say to you, you know,
I think on that, there's been absolutely no change in policy on the Business Payment Support Scheme or time to pay. No change of policy at all. What we're finding, or what HMRC are finding in a few cases, is that there are businesses that took advantage of the time to pay arrangements 1 year, coming back for a second year, and then coming back for a third year. And it was never designed as something that would sort of permanently enable businesses to be late with their tax payments. It's not there to essentially enable businesses that are only viable if they don't pay their tax on time to continue in that way. And so there are cases where businesses are going back for a third or fourth time, and in those circumstances HMRC is saying, you know, they're less likely to be saying, okay, that's fine.
Whereas it's the exception that proves the rule, if you like. It's an exception rather than an ongoing.
Yes, it is an exceptional case. Now, you know, when it was first brought in, and businesses were claiming for the first time, by and large, as you and I have talked about before, businesses were able to get time to pay on a fairly easy basis. Now it tends to be people coming back, you know, repeat requests, and in those circumstances, HMRC are going to be tougher. And you know, that's just the way it has to be, because it's not fair on those businesses that are constantly paying their tax on time. That they find that their competitors have an advantage. But you know, we are sympathetic. We know that times remain tough. We want there to be as much flexibility as possible. But the experience that I'm hearing about is, by and large, it is businesses wanting to go back for a second, third, fourth time where there are problems. Okay.
And the third, final one that somebody wanted to raise was to do with the Child Trust Fund and now the Junior ISA as well. It puts us in a position where a child could actually end up being handed over on their 18th birthday £100,000. As somebody who has children, how would you feel about your children receiving £100,000 on their 18th birthday?
Well, I'm probably not as thrilled about it as they would be, although I can assure you that it's highly unlikely that my children will be getting that much. I suppose I should say, as I'm not involved on a day-to-day basis with junior ISAs with my colleague Mark Hoban, but I think given the costs of child trust funds and the fact that decisions had to be made to make savings, the fact that we've been able to bring in the junior ISA is at least providing some help for some children in getting into the habit of saving. And this is a more cost-effective way of doing it.
David Gork, thank you very much.
Thank you very much.
Well, we're just going to go now and have a look at some of those measures from today's Finance Bill in a little bit more detail.